Welcome, everyone, to another exciting episode of the YouTube show and podcast, None of Our Businesses, where we talk about the week's business news, tax news, accounting news, any and all of the above. We always do it from an accountant's perspective. Usually we do it from three accountants' perspective, but today we've got two accountants. In the background, of course, is our producer, Ethan. So we technically have three people, but it's just Jack and I today. That's okay, though. I think you're going to find that we can really hold the fort here. And we're going to start out with drug testing, relaxing in the hiring process. We're going to talk about international tax policy coming out via tweet. What's up with car rentals? Strike that one. I don't know why I called it car rentals. What's up with the used car industry? And finally, the IRS's proposed budget from the Biden administration is a massive increase designed to massively increase tax revenue. Will it work? All right, well, let's get into it. I'll kick it over to Jack.
Well, here's an article to start us off this week, which we've talked about in the past on this podcast with, at what point were companies going to start getting a little bit more lenient in their hiring practices? And the first domino it looks to fall may be in the drug testing category. And what I found really interesting about this was some of the countries that are even involved. I mean, they mentioned specifically India, Romania, Singapore. I mean, nobody thinks of India as having a shortage of workers and having to relax standards to get those workers. But the fact that they're relaxing drug tests, and since marijuana is basically legal in about a third of the country now, that's the first one to go on this. And they're talking about Amazon being on the forefront of perhaps looking the other way if somebody has this show up on their drug test. Kind of dovetailing on this one was an interesting one. I've got a friend who is a senior financial executive at a metalworking company, and they've gone a little bit of a different route, not so much on the drug testing, but with felony records. They are willing to at least interview and talk to somebody who has a felony, as long as that felony isn't violent. So as companies struggle to hire workers, I think you're going to see more and more of these types of dominoes start falling. What do you think of that, Ty?
Yeah, I mean, I think it makes sense. I mean, I think the policy with regard to certain types of drugs, when you think about cannabis, for example, if you've got a workforce that it's really important that they're very highly engaged during particular working hours, maybe there's some kind of factor of danger involved in their jobs. You still had the issue, that if an employee was addicted to alcohol, for example, they could show up inebriated and present the danger, and you have to deal with that. And it wasn't the case that you could test or that you would test somebody for alcoholism and then exclude them from the hiring pool if they happen to drink alcohol in off hours, right? So I think that with some of the recreational drugs, it makes sense, right? It's going to be the same thing. It's like, well, it could increase some risks for on-the-job issues or on-the-job safety in certain industries, but the company should have the tools to handle that the same way they already handle potential safety issues with drugs and substances that were legal to use in the first place. So yeah, I think, and of course, if with the standards have to loosen. And so I think the first standards you always see kind of loosen are the ones that are more arbitrary in nature. So yeah, I think that's what I think that makes sense as a next step for employers to make sure they can get enough people going on the work that they need done.
Well, it's funny. It's times like these I wish we had a lawyer on this panel. It's one thing for accountants to weigh in, but you brought up an angle that I didn't even think about, but it is pretty obvious. If you're going to allow somebody that comes back with a positive drug test to go work on a line or operate heavy equipment or somewhere else where they could putting themselves, the public, coworkers at danger, what kind of liability will that open up for companies? And I think you're kind of right. They've already, they've adopted rules around, drinking, and it almost goes to with DUIs and that, as soon as you make marijuana legal, that doesn't mean you can go get high as a kite and then go hop in your car and go drive on the freeway. So I think, as they loosen the standards on some of these, you're going to have to put some of those checkpoints and those safety things in place, because especially at a company level, because you're opening up yourself to all kinds of liability. Do you have anything to add on that, Ty, or do you have another article for us this week?
Yeah, well, I'd say both, but I would double down on the, if I think about in our industry and in our business, for example, it's like there's no real reason for us to test for that kind of thing. I mean, of course, if somebody was an addict or using, it was impairing their competence, their work product wouldn't be very good. But as knowledge workers, it's like, well, there's a whole lot of things that could make the work product of our colleagues and our team members not good or incompetent besides just drug use. And so yeah, it's not even a factor for me. Like I don't really even consider like, oh, let me figure out or test or whatever if somebody working for us might be using drugs or not using drugs. I mean, that doesn't even come into the equation when I'm looking at hiring. So yeah, it's an interesting. I think it is how you look at that is industry specific, or
Sure.
you would think it would be.
Yeah, that's another great point. Yeah, I didn't even think of that, but you're right. Certain ones, yeah, we can. You could tune out and have a mental block, but you're not going to hurt anybody because you dropped a couple 1,000-pound pallet on somebody. So you're right. It's also almost industry specific, and that liability goes up.
Yeah. All right. Well, yeah, I've got an article for us here, and I actually wrote a little write-up on this on LinkedIn, and I called it International Tax Policy via Tweet. Let me throw this up here and look at it while I'm talking here. So, yeah, I mean, I think there's a couple different angles on here. First, and both of the articles that I'm going to throw in today have this theme to them about how the world has changed and how, kind of sophisticated information about tax policy and situations are getting communicated in today's world, right? And in this article, the issues are being communicated via tweets. And another article I'm going to do later in this episode, the information was being communicated via somebody else's blog, government blog that somebody was writing in, I should say. But in this particular issue, international tax policy emerging via tweet, I pulled this from Thomson Reuters, who was reporting that Secretary Yellen, the Treasury Secretary, has been urging Congress to go for the plan from the Organization for Economic Cooperation and Development. That's the OECD. And that organization, the OECD, is basically a group of nations that works together to try to has been working together to try to establish kind of rules of the field, or the game rules in terms of international taxation of which country should get to tax what kinds of things, and how you would determine with multinational companies how their income is split between various countries, and who should get that tax revenue, right? So that organization works on like best practices for treaties, for transfer pricing, for sourcing of income questions and tax jurisdiction issues. And they've been working on a plan that elements of it are kind of showing up in the themes of the latest Biden tax proposals. And so I want to get into that, but it was kind of a tangential point that, she's making these urges to Congress, Secretary Yellen, that is, she's making these urges to Congress via Twitter. So that's the world we're in today, right? Is such a serious topic, yet we're reporting here on information that's coming at us via what's being tweeted. So Biden's Made in America tax plan, which we're looking at potentially being looked at and passed perhaps by the end of the year. I mean, typically that's what happens with Congress, is they debate these things and they push it till the very end of the calendar year, and then at the 11th hour they pass something, right? That's what happened in the last tax act, the major one that came through the Trump administration. And now we've got Biden's administration and this major tax act, which they're calling the Made in America plan. And in this plan, there's a lot of different things, but in terms of the international tax provisions, it would overhaul the U.S. international tax rules yet again. And I say yet again because the Trump tax act, which came out in late 2017, really overhauled the U.S. tax rules for international business. And this new Biden tax plan would do the same thing, would kind of overhaul these rules again. And the intent of the intent of Biden's plan with regard to the international provisions is to try to make U.S. companies more competitive by trying to eliminate incentives for offshoring, companies offshoring. And one of the things they're looking at for doing that is this idea of a minimum book tax of 15%. And I think what they're promoting with that, or what they mean by that, is that you can't offshore and get a lower tax rate. If your tax rate is less than the minimum rate, you'll still pay the differential to someone, presumably the U.S. if your headquarters is in the U.S. kind of thing. So I haven't I don't like to dig into too many details of these things early on, because they kind of change and it's a lot of work. And frankly, I'd rather do the work once we know what's what, as we get closer to an act actually passing. But it is interesting to kind of see the direction of where things are going. And this idea of this minimum global tax kind of thing is aligning with that organization I was talking about, the OECD plan, because that's kind of what they proposed. Their purported objective was to ensure that enterprises pay their quote unquote fair share of tax wherever they operate. I say that phrase fair share because I'm supportive of the idea of cooperation between nations to try to create more of a global minimum tax. But anytime an organization talks about other people, about people or companies' fair share of tax, it's like, well, that's a very subjective thought. What do you mean by somebody's fair share? So I think whenever you start instituting those words, you're into some territory for potential disagreement for sure. But one of the targets of the OECD plan is digital companies, which is the kind of companies we often work with, whether they provide digital services or they're digital software companies. And one of the things that, if you're a global enterprise and a digital company, that you have a lot of potential leeway right now with, is how you source your income, depending on where exactly you're doing the work, or where exactly you happen to be headquartered, or even where exactly your servers happen to be, right? And so that's one of the things that the OECD is trying to tackle, is this idea of divorcing the tax jurisdiction from simply being where you have physical presence, and tying it more to where does a company actually earn its profits. So that would be a big change if the OECD can get countries to agree to that, and if the US or the other countries actually push that kind of idea forward. And as I mentioned earlier, the OECD plan specifically gets into the concept of a global minimum corporate tax in order to prevent countries like the US from losing their kind of tax base, because multinationals are trying to shift their income into low tax jurisdictions. And so the Biden tax plan is right in line with this idea. And I would point out that the last tax act under the Trump administration back in 2017 seemed to try to be dealing with the same thing. So it's not like a global kind of minimum tax is a uniquely progressive or left idea. I think arguably the last tax act was trying to get at this with the idea of the global intangible low taxed income regime that was passed. But it was a pretty complicated bit of tax legislation that left some glaring holes, and it didn't quite seem to hit the mark. And so I'm not opining that the Biden plan will hit the mark, but it's to me reasonable to try to improve upon that and see if they can do a better job of hitting the mark, to get kind of a more global tax system that doesn't incentivize companies to just seek lower tax jurisdictions other than the US. So we'll see if this new way of doing it and promoting it via tweet can actually get us there. I'll turn the mic over to you, Jack, to see kind of what you think about all this.
Okay, I've been jotting down notes as you've been talking, and a couple of these points, I mean, we've talked about before on this show, but yeah, I think you're right. There might be points that are different, but basically the spirit of both of these plans is, I think, both administrations, the ultimate goal is to try to, disincentivize people from offshoring. So whether they get it done or not, that's another different story. and you're right, we're absolutely in this, let's face it, Trump's presidency was a lot of his goals and directives, the origination was Twitter. So I guess that's kind of here to stay. Something else, and we have talked about it on this show before, is it'll be interesting to see if you can get not only two parties to agree in this country, let alone maybe even one party. The Democrats probably won't agree on all of these points, but when you try to roll this cooperation out worldwide, and I'm not sure that the U.S. is seen as the leader that they may have once seen, and this obviously something like this definitely requires leadership. I'm skeptical whether or not we'll even be able to get everybody on board in this country, but let alone trying to roll this out globally. I'd love to see, what kind of cooperation we get. But, there was another point in here. And if this becomes, status quo where for a long time, I know Reagan did a considerable change to the tax code in the 80s. And for the most part, the tax code, there's changes, there were changes here and there, but they weren't these major overhauls. If we get to the point where every time, whoever's sitting in the White House does a major overhaul of the tax plan, I'm thinking it might be a great time to be an accountant, to which I think we have fewer graduates of. And it may be a good time to be an accountant who specializes in tax, because as we talk about these things, there's a couple of people that make out like bandits. And, every time you hear about plans like this, it's a subsidy to every accountant out there who wants to perform tax work and keep up with these types of things. Lastly, I want to point out something else that you'd mentioned before, and this caused us angst multiple times. Every time they finally do come to agreement, and I think they roll into the holiday season and they threaten to hold them over, and that's when they all capitulate and come up with some half-assed plan that probably nobody likes or wants, but they all get to go home. And unfortunately, they do that very late in the year, and they don't really, well, I'm sure they don't really care, but they don't think of the downstream to everybody else. And at this point, even the IRS becomes a sympathetic character, because they have to revamp a bunch of forms and a lot of other things. And you're already heading into a tax season, and you're not prepared forms-wise, guidance-wise, anything-wise. You put that much of a burden out there on that tax community, which I go back to that other point. Might be a good time to start looking into being a tax accountant.
Yeah, 100%. I just kind of throw in on something you said there. Leave it to Congress to make the IRS look sympathetic, right?
It takes some doing.
Yeah. All right. Well, what do you have, Jack?
Okay, well, another topic we beat to death on here, and this is kind of a more subtle way, but I think a way that's probably going to affect a lot of people, and they're going to see it. It's not just the construction of the trades. We talked, I think, last week or the week before about the semiconductor shortage. Well, the fact that we have that has virtually, I wouldn't say shut down, but it's severely slowed down new car production. So one of the effects of that is that these car rental companies who used to, they'd run a car for 25 to 50,000 miles. That was the sweet spot for them. They'd send them to auction, sell them to the public, buy new cars, and restock their fleet. Since it's going to be harder to get new cars, they've decided to hold on to these cars up to 90,000 miles in mileage. So a couple of different things here. It was interesting. Within the last year, I've had conversations with people that bought cars, and 6 months later, they actually could go back to that same dealer or any other dealer and trade that car in for more money than they paid for it. So I'm almost looking at this as you're going to see a similar thing, because I think you're going to see a shortage of late model used cars. And I think you're going to probably see the same thing. These dealerships, or people that are shopping for those, are going to want, there's going to be a shortage of them, because I got to think car rental companies, they have considerable amount of inventory. It almost reminds me of the story back when it was it's funny how different things affect different industries. This goes back to the financial crisis. And when the financial crisis first hit, you couldn't sell anything. But then I worked for a company that was divesting. It was a truck dealership, and they had the whole barrel. They had new truck sales, used truck sales, leases, parts, the whole 9 yards. Well, it got to the point where you could not give away a new truck, because with the EPA regulations every year, $7,000 to $12,000 more a year would go on to the cost of those new trucks. and it was a financial crunch. Nobody had any money. But what came out of that was the fact that nobody wanted to buy a brand new truck. But if you had the right late model truck, they were selling like hotcakes. You could have one, and you could send somebody send somebody a picture of one in New York, and they would buy it sight unseen in Ohio just because it was the right truck and what they were looking for. So we're talking about a lot of different supply chain disruptions on this show, and I think this is kind of just another one. So I think look for some strange events to start happening in the late model used car market.
Yeah, it's downstream effects, right, of what we talked about in kind of previous episodes of the chip shortage and how that's affected the new car market. And we were talking not specifically about vehicle manufacturers, but I think it was in our last episode, or maybe the one before that. But in a recent episode, we were talking about how, and I think I made the comment that it wasn't clear to me whether companies were really suffering from the supply chain shortage, or whether they kind of stood to gain excise profits from it because of the increased demand and the fact that they could lower some of their overall variable cost by just not having to sell as much things, but they can sell each thing at a higher price because of the increased demand. And would you know it, that the Wall Street Journal had an article that I was reading last week that, in fact, that was the case that seemed to be the case for the car manufacturers and the new car industry anyway. And so, yeah, I thought it kind of relates to this issue in the sense that I think I think that's right. That what you're talking about today is the downstream effect of that same story. It's one big saga, right? That there's a shortage in the chips, which is leading to a shortage in new cars, which has increased the prices and therefore the profitability per car for the vehicle manufacturers and the retailers and the dealerships, I should say. And we would expect that downstream, the used car market is also benefiting now, because the shortage means that, well, if there's not enough new cars, people are looking at that market and they can't even find the reliable used cars they want at lower costs. They're paying more for used cars than they ever did before. So it's made that industry better in the sense from a profitability standpoint, presumably, because the dealers are getting a higher price per vehicle. And on that point, in the used car market, it's not like, the inventory is the inventory that's there because of the used cars. It's not like they're creating new used cars. They're not going out and manufacturing them, right? So it's like their inventory is somewhat what it is. If you look at it at a macro scale, I mean, micro, yes, one used car lot can get more or less inventory than another used car lot, but at a macro scale, the inventory of used cars is what it is, and the overall price per unit is going up. So that industry stands to benefit from this for sure.
It's interesting. So I'm at the BNI meeting this morning, and we have, I think he's in there as a roofing contractor, but we have a gentleman that's got a contract, and they do roofing, they do gutters, they do siding, they do windows. And his push this morning was, if you've got, those leaky roofs, or a roof that's worn, or your gutters are falling apart and they're leaking, they are able to get materials, as he calls it, essentials. I mean, if you've got a leak, I've been into a ton of houses, and nothing destroys a house faster than a leaky roof. He said those emergency type things, those materials were available. So with it being mid-September here in Cleveland, and probably 2 months from now, this might not be the case, but there's still plenty of time to, if you put an order in now, to get those repairs done. He further went on to say, if you want to get siding on your house, that's not the case, because siding, which wouldn't be so non-essential, is on back order, and there's material shortages. So like he said, he goes, we can't get your house sided before the snow starts flying. He didn't mention anything on windows. I think it's kind of cool, the four that he has done, because you'd think they'd kind of counterweight each other. But I thought it was kind of interesting how, just a different type of material, forget about it. You're not going to get it done, but those other materials were available, and he could get that work done. It seems to we talk about these events on here, and it seems to pick winners and losers on a weekly basis.
Well, with that, let me roll us into a totally kind of different topic, which is We were talking earlier about the potential sympathies for the IRS if Congress is giving them a lot of work to do at the last minute. But I think what we're going to talk about now, the topic that I have for us is not going to make us overly sympathetic to the IRS. Not that they're themselves doing anything wrong with this, but the issue is that the Biden administration is promoting increasing the IRS budget as a way to increase government revenues, federal tax revenues. And similar to the earlier article that I was discussing, or the earlier topic I was discussing, we know about this kind of from new media, so to speak. So Phil Swaggle, who I hope I'm saying his name right. I'll go with his first name here, Phil, who's the director of the Congressional Budget Office. He published a blog article on a government website, and it was titled "The Effects of Increasing Funding for the IRS." And essentially, the CBO was doing an analysis of the Biden administration's proposal to increase IRS funding. And what the CBO believes is that if they're increasing the IRS funding by $80 billion between 2022 and 2031, that increase would increase tax revenues by $200 billion over those 10 years. So essentially, they're evaluating that there is a return on investment, that investing in the IRS, you'll get a return on investment in terms of tax revenue. And I think our viewers probably know this, our audience probably knows this, but I think it's always important to put this in context or remind people of this point. The IRS does not create tax law. So increasing the IRS budget is not about them creating more tax laws. Increasing the IRS budget is about them enforcing existing laws, right? It's about them enforcing the laws that are on the books. It's not about them trying to create more tax laws. That's not to say that, I talked about earlier that the Biden administration has a tax plan which would potentially change tax laws. So I'm not suggesting that Biden is not looking at both, but this particular topic is not about changing tax laws. It's about funding the IRS to enforce the tax laws that are in place at that point. And this amount of funding, it's like it would increase the IRS budget by more than 90% than its July 2021 budget baseline is, and it essentially doubles the IRS staffing, according to the blog article by this CBO official. Some of the other interesting points about it is that, I think the obvious implication here is that the estimated ROI, the estimated return on investment here of being able to get more tax revenues out of taxpayers is because there's an expectation that with a bigger IRS, more funded, with more revenue agents and increased enforcement activities, that would actually change the rate of voluntary compliance. That is, that you and I and everybody else, taxpayers, would just voluntarily comply more and pay our more there we go again, our fair share of tax under the law anyway, because we just know that it's being more heavily enforced, right? But one of the key caveats that the CBO put in this is that whether this actually works is very dependent on the IRS's ability to hire experienced candidates. They're careful to say, this is one of the key call outs, is they say, the IRS might not be able to hire its desired mix of candidates. In other words, the experienced folks, right? And so if and also you have a certain amount of attrition, the current cadre of IRS agents that are experienced could be, who knows what their rate of leaving would be either. And so those caveats were placed in there to say, this whole plan of increasing the funding to increase revenue could be shot in the foot, or could be basically not as effective if they're not good at and effective at hiring the right people. And I think that's true of any organization, right? So that's, I guess, another way of saying this is all good in theory, but as with anything, it depends on execution. And I guess you have to have a certain amount of belief in the IRS's ability to execute. So, Jack, I bet you've got a lot to say about this. So let me throw it over to you.
Let me ask you first. What did you say that return ratio was? They were going to spend how much more to get how much in revenue?
So they are expecting to spend 80 billion to get 200 billion, and I'll call up my Excel so I don't have to do that math in my
That's what
head.
I thought. All right, so yeah, because I thought that's a little over what, 1.5 times,
Yeah, it's 2.5 times.
2.5 times. Because it's interesting. I mean, I've seen studies like that in the past that have been like 6 to 8 as a return. So I think that's actually pretty conservative. Now, I think the dirty little secret is we all know. I mean, they're like I say, we've seen these studies before, and like I say, I'm used to seeing them where they've talked about a 6 to 8 return multiple on these investments for all the reasons you categorize. I mean, just the fact that more people are looking. But here's the big thing, and here's something that you didn't touch on. That when I hear stories like this was, politicians have known this forever. But the thing that stops them from doing this, there's a fine balance there to where you make it so, every single one of these people that gets collected on or the IRS, that's another voter that's pissed. And that voter tells 5, 10 other voters. So at some point, even though this is, every time they've done this and increased the budget, they've seen a return on an investment. There is definitely an inherent political risk here, because if you're the party in power, you're collecting more revenue, but you got more people that are pissed at you. That's just all there is to it. So I think this is the fine line that they haven't decided to do. So I think that's a pretty aggressive move, almost doubling, their entire workforce. And I would say, whether they get an experienced person there or not, it's almost like we've talked about when it comes to enforcement. Presence is important. Just parking a police car with nobody manned in it gets people to slow down when they're driving by it. It's just that simple. So the fact that they know you make a big, bold, splashy headline that the IRS is beefed up and there's twice as many agents, right off the bat, you're going to get people that are going to be a little bit less willing to, I guess we'll be polite here and say, push the envelope. So when I hear stuff like this, it's studies have proven it, but they're walking a tightrope, because there's no way of getting around this. This is definitely a political issue. You will recoup more revenue, but you're gonna turn a bigger segment of the public against you. That's kind of the way that's how I see it.
Yeah, I really related to the topic of the experienced people, because what I know from my experience as a prior tax professional in the corporate and partnership environment is that where there's kind of big money is in complex areas of tax law, including the international area that we were talking about in the earlier in this episode. Certain kinds of credits, business types of credits that require a certain amount of experience and expertise to kind of figure out the correct application of the tax law on those things. Accounting methodology issues that could relate to inventory and capitalization issues with things in property and equipment, things of that nature. And then just partnerships in general in terms of how businesses allocate income and deductions around different members of their LLCs or partners of their partnerships using partnership tax law concepts. These are all pretty tax nerdy, heady kinds of topics. And unfortunately, I think that the problem is your average revenue agent isn't really up to the task of going after those. And so if they increase the I predict what will happen, and what's going to be frustrating for the corporate public and the corporate taxpayer world, business taxpayer world, I should say, is that if they just double the size of the IRS without the right amount of expertise of who they're bringing in terms of having enough tax and or accounting understanding and experience, they will have a lot of revenue agents running around poking at things that don't fully understand what they're poking at, right? Like, they might kind of see something's wrong, but never really have the experience or expertise to really identify what's wrong. And the taxpayers, the bigger taxpayers where the big money is, will always have the tax professionals, the accountants and the lawyers who will be able to construct the arguments for why their position is better. And I think the IRS is ill-equipped to battle that, because they, and so I think what you'll have is you'll just have a lot of agents going down dead ends. They'll pursue things that never quite have an ROI on them, because they don't have enough expertise to know what would have an ROI, what would actually result in something, and then be able to make that argument deftly against more experienced experts in the field outside of the IRS. So yeah, that would be my concern. If they engage in this without deploying people with more expertise, I think it would be a fool's expedition. And so, yeah, execution is everything. And I don't know that I have great faith in the way any government agency executes anything. So.
Well, it's interesting. Another point you bring up there, the fact that the inexperienced aid. Let's talk. We talk about the multiplier on collections, but let's talk about the multiplier on aggravation. That's that many more taxpayers who get a letter in the mail or a notice in the mail, call into the IRS and don't get a knowledgeable agent and don't have a good experience and don't get their problem resolved, and end up calling 5 or 6 times to resolve an issue. And again, those kind of people tell everybody that within earshot. And like I say, that's where I think a lot of these things, they might sound good on paper, but it's beware what you wish for. There's going to be a lot of, perhaps unintended consequences, because there's definitely going to be a backlash from the public. And to your point, especially if you roll out with a bunch of inexperienced agents, because, it's hard enough when you call in and get an agent that knows what they're doing. You call in and start getting an agent that passes you around, ends up hanging up on you accidentally, can't get you the answer you want, gives you, or worse yet, gives you the wrong answer. There's a lot more that could go wrong here with inexperienced agents. I agree with you on that point.
Yeah, there's a lot of complicated, there's a lot of things that look complicated on the surface that I think that they could spend a lot of time digging into, that actually are either just correct, they're complicated, but they're correct, and more experience would tell them on the front end that was the case, or they're complicated and they're incorrect, but more experience would tell them that they're not going to get anything out of it anyway, that getting it right, or had the taxpayer done it right, it wouldn't have resulted in a lot more tax. And on the flip side, you have complex scenarios that on the surface look easy, look simple, and maybe look right, unless you have the experience to know that, yeah, it's not that simple, and that there actually is something under the hood there that's probably not right, that actually would result in more tax. And I think just not having enough expertise and experience to issue identify on the front end is going to result in just a lot of people spinning their wheels and time wasting and aggravation all the way around.
It's interesting. I remember working at a community college, and the system they had in place, mandated at least, whoever took the call was going to pass it off to at least one person. And the way I kind of look at that, the more you can get that person that takes that phone call to be able to resolve that issue, the better off you are, because already right off the bat, you're passing it to somebody else, and it already has given a bad taste in somebody's mouth. So, yeah, a lot of that'll be an interesting one. Everybody else is struggling to find qualified, trained people. I can't imagine it's going to be any different than for the IRS.
Right. Yeah. I mean, and what advantage? I mean, it's unlikely they're going to pay more than the private sector. So, the only advantage is that they maybe have a better benefit system or more job security and things like that. So yeah, let's wish them good luck if this is the direction they're going to go, and that they don't spend our tax dollars in a foolhardy way that just aggravates us all.
Hey, thank you for joining us for yet another episode of the YouTube show and podcast. None of our businesses. Again, interesting show. There's only 2 accountants this week, but we had some very good topics. Hope you enjoyed them. Tell your friends about it. We're never truly alone. We always got the best producer in the land behind the scenes, and that's Ethan. He keeps us in line. He keeps us going. He edits out all our stutters. So kudos to Ethan. Hope you enjoyed the 2-man gang, and we hope to see you back here next week when we'll probably be at full strength. Charlie will be joining us again, and we'll talk about some more interesting topics. Have a great week, everybody. Thank you for joining us.
Hi, everyone.